All right, so we're looking at the reducing balance method for depreciation. Right, this is the formula here. Depreciation is the equals cost minus accumulated depreciation. This tabulation in the brackets here is the net book value. Net book value is just how much the asset is worth at that time period. All right. So we've got a question here. A motor vehicle was bought for 100,000 on 1st January 2025. The rate of depreciation is 10%. Show the calculations for depreciation, the journal entries, and the extracts of the financial statements for 3 years. All right. So we're going to start with year one. Okay. Year one. So depreciation, well, you are dealing with at the end of the year, all right? So at the end of year one, right, depreciation equals cost minus accumulated depreciation times the rate. So the cost is 100,000. Accumulated depreciation, there's no accumulated depreciation at for the first year. So it's 0 multiplied by the rate, which is 10%. Okay. So 100,000 minus 0, that is 100,000. Then times 10%. 100,000 times 10%, that is 10,000 kwacha. Okay, so this is the depreciation charge for the year, all right? So the journal entry is going to be like this, all right? Depreciation. So they charge the depreciation expense on the financials. So on the statement of profit or loss, the depreciation expense is going to be 10,000. Then you always credit accumulated depreciation. Accumulated depreciation. Remember, this is a contra asset. Okay. You credit it 10,000. So let me show you what's happening in the T account. Where's the draw item? Okay, let me use here where I can draw. Okay. So for year one, the depreciation expense account, and you have the accumulated depreciation. Okay. So you're going to put here debit depreciation expense 10,000 and you credit accumulated depreciation 10,000. Okay. Now remember, the accumulated depreciation account is a permanent account, meaning it has a balance carried down. Okay. You take the balance, you transfer it to the next year. This depreciation expense account is a temporal account. Every year you have to close it. Okay, so how you close it, you just credit, say to the statement of profit or loss, you just credit this account 10,000 and you have closed the balance 0. Okay, now for the accumulated depreciation account, all right, at the end of the year, you say balance carried down 10,000 here. Okay, the balance carried down always comes on the opposite side. Okay, Then, in the beginning of year 2, the balance brought down for depreciation is going to be 10,000. Okay, this is for year 1 here. Okay, year 2. Okay, the accumulated depreciation balance for year 1 is going to be brought down to year 2. Any questions so far? Extract. So the statement of profit or loss, you are going to put depreciation expense, 10,000. Okay. After you've got your gross profit, you've added other forms of income, then now where you tabulate your expenses. Then in your balance sheet, cost here, accumulated depreciation. Then here you have net book value. Okay. You're going to put here motor vehicle, cost 100,000, accumulated depreciation 10,000, net book value is going to be 90,000. Okay, these are the financial statement extracts for year 1. Any questions before we go to year 2? All right, so year 2. All right, we calculate the depreciation expense for year 2. Same formula here. Only this time now, under accumulated depreciation here, we're going to put 10,000. Okay, we're going to put 10,000. The balance carried from year 1 has been brought here. Okay, so 100,000 minus 10,000, that is 90,000. 90,000 times 10%, 9,000. Okay, the depreciation expense for year 2 is going to be 9,000. What's happening in the T accounts? Okay, year 2, depreciation expense, you're going to put here 9,000. Remember, this is the reducing balance method. So have you seen the depreciation expense is dropping each year? All right. Then you close this account. 9,000 here. Okay, 9,000 there. So we close the depreciation expense account for the year 2. Then here under the accumulated depreciation account, remember what the balance brought down of 10,000. Now we've brought in a 9,000 for this year. So the total depreciation, accumulated depreciation is 19,000. Okay, so we're going to say here balance carried down 19,000. Okay, then in year 3, the balance brought down for year 3 for accumulated depreciation is going to be 19,000. Okay. So the journal entry, debit depreciation expense, and then you credit accumulated depreciation. Okay. Debiting depreciation expense 9,000. Crediting accumulated depreciation 9,000. Okay. So on the financial statements for year two, statement of profit or loss, depreciation expense 9,000. Balance sheet, okay, accumulated depreciation, remember 10,000 plus 9,000, which is now 19,000. Okay. So 100,000 minus 19,000, 81,000. That's the net book value, 81,000. Yes. Any questions before we go to question year three? Okay. Year three comes around. Calculate the depreciation expense for year three. So you're going to say cost minus accumulated depreciation. So you're going to say 100,000 minus 19,000. That is 81,000. 10% of 81,000. 10% of 81,000 is 8,100. Yes, we continue where we left off. We're calculating the depreciation expense for year three. Okay, cost minus accumulated depreciation. 100,000 minus 19,000, you get 81,000. 81,000, 10% of 81,000 is 8,100. Okay, 8,100. So the journal entry again here, depreciation debit 8,100. Okay, this is what you're going to see there in the statement of profit or loss, the expense. Accumulated depreciation, you're going to get, you put 8,100. Okay, colleagues. So on the T accounts, we already know what's happening for the depreciation expense account. Debit 8,100, you close it. On the accumulated depreciation side here, year three, there's a balance of 19,000. Then we brought in 8,100 for year three. So 19 plus 8,100, that should be 27,100. So balance carried down 27,100. Okay. Balance brought down 27,100. All right. So the extracts of this statement of profit or loss, depreciation expense, you're going to put here 8,100. Okay, accumulated depreciation is now 27,100. 27,100. So net book value, cost minus accumulated depreciation, 100,000 minus 27,100, you get 72,900. Okay, colleagues. So this is how depreciation works on a year-to-year basis. Okay. As you can see with the reducing balance method, the depreciation expense is dropping. It's dropping. Unlike straight line method where it was just constant, here it is dropping.